Greetings to our listener. Today we're embarking on a deep dive into some truly groundbreaking research. It offers a fresh perspective on something a lot of us grapple with in finance. How to cut through all the noise and really understand short-term market movements. We've got some fascinating insights to unpack, promising a new way to look at stock prices, not over months or years, but really in the immediate term. We're thinking hours, not days. Imagine being able to predict with, well, remarkable accuracy whether a stock price is likely to go up or down in the next few hours. That's precisely what our sources today are exploring. We're going to delve into a novel concept called the financial torque hypothesis. Sounds fancy, right? And we'll reveal how advanced machine learning, specifically a type of AI known as long short-term memory neural networks, or LSTMs, is being rigorously applied to put this hypothesis to the test. Our mission today is really to extract the most important nuggets from this, frankly, dense research. We want to make sense of these technical indicators, understand the power of these sophisticated machine learning models, and ultimately grasp what it all means for our comprehension of fundamental market dynamics.
Indeed. And this deep dive, it introduces a really compelling new framework for understanding market momentum. It pushes beyond the boundaries of, the traditional indicators we usually look at. What's particularly intriguing here is how the researchers have drawn inspiration from an almost unrelated field, mechanical engineering. They've taken this concept of torque and masterfully applied it to financial markets to explain those often elusive short-term price movements. It's really about uncovering these hidden forces within the intricate market microstructure, forces that can reliably predict directional shifts. So we'll explore the core components of this hypothesis, dig into some truly surprising findings about the subtle power of different types of data, and consider what this all implies for those long-held theories about, how efficient our financial markets truly are.
Okay, let's unpack this then. The big idea, the heart of this research, is something called the financial torque hypothesis. Now, the name itself, it sounds quite formidable, right? It invokes complex physics. But the paper actually gives us a surprisingly intuitive analogy to help us grasp it. Really helps visualize this kind of abstract financial concept.
Precisely. Just as torque in a mechanical system refers to a force that causes rotational motion, think of using a wrench to tighten a bolt. The force you applied at the handle creates that rotational effect, twisting power. While the financial torque hypothesis posits that specific imbalances in trade volume happening within certain price levels can exert a similar directional momentum on future price movements. It acts as a driving force for short-term price changes, a kind of directional pressure or twist on the market, if you will. And this represents a significant departure from just looking at past price history, like, a simple line chart, which only shows you the result of market forces. Instead, this hypothesis digs much deeper. It gets into the underlying activity and the flow of trading within those price levels. It looks at how trades are actually happening, not just where the price ends up. It's about the dynamic interaction of buying and selling pressure, really.
So it's not just what the price is doing at any given moment, but how and where people are intensely trading at those prices. That's what generates this torque, this directional force, right? The research team clearly believes these are the most potent signals because they meticulously focus on just two key indicators to measure this. That seems like a very deliberate choice.
That's right, and it's a crucial aspect of their methodology. The two fundamental microstructure features they leverage are incredibly specific, yet profoundly insightful. First, they utilize the volume-weighted average price, or VWAP. Now, many listeners will be familiar with VWAP as a crucial benchmark for institutional trading, but what's truly innovative here is how the researchers leverage its granular weighting by volume. Its definition is pretty straightforward. VWAP is essentially the average price a security has traded at throughout a specific period. But here's the crucial part. It's weighted by the volume of each individual trade. So if a lot of shares trade at a certain price point, that particular price point has a much stronger influence on the calculated VWAP for that period. Its significance for detecting market imbalances is profound. It's widely used by institutional traders precisely because it provides a more accurate representation of where the true center of gravity of most market activity actually occurred. It cleverly integrates both price and volume information. It's not just a simple average of prices. It reflects where the significant capital changed hands. For example, let's say a stock trades at $10 for 100 shares and then a minute later at $11 for 1,000 shares. A simple arithmetic average would be $10.50, but the VWAP for that period would be much closer to $11 because the vastly higher volume at that price point pulls the average towards it. It truly shows you the gravitational center of trading activity during that period. It helps reveal if large, influential trades are happening at the extremes of a price range. Second, they use trade count. This indicator is equally important and distinct from raw volume. Its definition is clear. This isn't about the total number of shares traded, like traditional volume. Instead, it's the total number of individual executed trades in a given interval. So, for instance, 1 million shares could be traded in one single massive block order. That would be high volume, but a very low trade count. Conversely, 1 million shares could be traded across, say, 1,000 small, rapid trades executed by high-frequency algorithms. That would result in high volume and a very high trade count.
Okay, so it's about the frequency, the sheer number of transactions, not just the size.
Exactly. Its significance lies in capturing the intensity of market activity and the breadth of participation. A high trade count, even with moderate volume, could signal intense high-frequency trading where many small orders are rapidly executing. Or it could indicate broad, increased market participation for many individual or smaller institutional investors. It potentially highlights breakout zones where stock is trying to push past a resistance level or consolidation periods where buyers and sellers are fiercely battling it out. It reveals the dispersion and frequency of trading activity, which, speaks volumes about underlying conviction. The core of the financial torque hypothesis then states that when a significant proportion of trade volume, as indicated by this trade count, is concentrated specifically in the upper or lower portions of a price candle's VWAP range, it signals underlying directional momentum that can predict the direction of subsequent price movements. For example, imagine a stock's price bar for a 5-minute interval, often visualized as a candle on a chart, showing its open, close, high, and low for that period.
If, say, 80% of all trades occur at or above the top 10% of the VWAP bound for that period, it exerts strong upward pressure like a powerful force on a lever, pushing the price higher. Conversely, if most trades are clustered intensely near the lower VWAP bound, maybe 80% of trades below the bottom 10%, it suggests a clear downward momentum as sellers are dominating at lower price levels. This concentrated directional trading activity, which they term financial torque, is precisely what they're trying to measure and predict with. It's the silent, subtle force within the market's inner workings.
Now, this is where it gets truly compelling for me. The paper explicitly states that they restrict their analysis solely to these technical indicators, VWAP and trade count. They don't incorporate other common data sources like sentiment analysis from news articles or broader macroeconomic factors or even company fundamentals. This seems counterintuitive, right? To ignore so much potentially relevant information. Why is that so crucial for their approach? What's the strategic advantage in this narrow focus?
Yeah, that's a great question, and it raises a profoundly important point about information processing in financial markets, especially in the context of the efficient market hypothesis, the EMH. Under the EMH, specifically its semi-strong form, all publicly available information is supposedly incorporated instantly into prices, making it impossible to consistently profit from future price movements. However, the researchers argue for a fascinating distinction here. They posit that technical indicators like VWAP and trade count act as a real-time summary of every single market participant's reaction to new information, often before that information even becomes widely known or published through traditional media channels.
So they're saying these indicators are faster than the news.
In a sense, yes. They highlight a critical time lag. By the time a major news story hits the wires or is picked up by traditional sentiment analysis tools that rely on natural language processing, market insiders or large, sophisticated institutional players might have already reacted and traded on that information. But crucially, these technical microstructure indicators, VWAP and trade count, have already absorbed those trades in real time, second by second, minute by minute. This means you're getting exceptionally low latency, high-fidelity signals derived directly from executed trades and underlying order flows, which is absolutely ideal for high-frequency trading settings or any short-term prediction model.
Okay, that makes sense. It's closer to the source.
Exactly. In stark contrast, sentiment analysis, for example, has significant inherent latency issues. It has to wait for news to be published by a reputable source. Then an algorithm has to ingest that text, parse it, interpret the sentiment, positive, negative, neutral, and then categorize it. This multi-step process introduces inherent delays and also carries significant risks of misclassification or misinterpretation of nuanced language. So by focusing solely on these microstructure measures, the researchers are ensuring they capture the most immediate, unadulterated, and actionable representation of market dynamics. They're cutting out all the middle steps, the human interpretation biases, and the inherent noise of delayed information. It's getting as close to the raw, real-time pulse of the market as possible.
So what does this all mean for someone trying to understand, the very fabric of market efficiency? Because if the traditional efficient market hypothesis says prices reflect all information instantly, how can there possibly be predictive power in these patterns? If the information is already priced in by the speed of modern trading, where do these opportunities for financial torque even come from? It seems like a contradiction.
It does seem like one, and this is a core and direct challenge to that traditional idealized view of the EMH. The financial torque hypothesis suggests that even in highly liquid, seemingly hyper-efficient markets, where you might expect perfect instantaneous price discovery, certain frictions and realities persist. These include things like subtle order execution delays, the need for market makers to manage their inventory of shares. They can't just buy or sell infinitely instantly, and the sheer diversity of trading strategies employed by millions of participants. These factors impede the instantaneous, frictionless incorporation of all order flow information into prices. These aren't perfect, frictionless systems. They are, in reality, incredibly complex adaptive systems with inherent lags.
So there are little delays, little imperfections in the system.
Precisely. These imbalances, these fleeting pockets of financial torque, persist just long enough. The researchers call it a slight delay or a microstructural friction to create recurrent intraday arbitrage opportunities. Think of arbitrage in this context as quickly capitalizing on tiny, temporary price differences or imbalances before they vanish. The model's entire aim is to capture and exploit these micro inefficiencies before the broader market fully adjusts. And those fleeting arbitrage opportunities are arbitraged away by faster players or simply disappear as information disseminates. It aligns perfectly with broader academic literature on intraday momentum, which has shown that stocks can indeed exhibit short-term price continuations. The torque framing simply provides a much more coherent and intuitive theoretical underpinning for why these continuations occur, tying it back to the very mechanics of how trades are executed and absorbed into the market. It's fundamentally about exploiting those tiny, brief lags in how information, specifically the raw trading activity itself, is fully reflected in price. It suggests that perfect efficiency is an ideal, not always a reality, especially at the minute-by-minute level.
Okay, this all sounds incredibly compelling in theory, but, the proof is in the pudding, as they say. How do they actually build a system to put this financial torque hypothesis to the test? You talk about long short-term memory or LSTM networks. That's pretty advanced AI. How do these LSTMs fit into translating this hypothesis into a working predictive engine?
Right. LSTM networks are indeed a specialized and incredibly powerful type of recurrent neural network, or RNN. They are perfectly suited for capturing long-term dependencies and sequential data, which financial time series certainly are. The market's behavior now is, inextricably linked to its behavior moments, minutes, or even hours ago. Unlike simpler neural networks, which might struggle to remember information from earlier in a long sequence, LSTMs were specifically designed to retain information for extended periods. They achieve this sophisticated memory management with a unique internal structure. It involves a memory cell and 3 intelligent gates: an input gate, a forget gate, and an output gate. Now, instead of getting bogged down in the deep neural network mechanics of how these gates work, it's probably more useful to just imagine them as highly selective filters. These gates intelligently regulate the flow of information. They allow the LSTM to selectively remember what historical information, whether it's trading patterns from minutes ago or several hours ago, is crucial to retain, and what to forget because it's no longer relevant when making a prediction. This intelligent control over memory makes them exceptionally effective for modeling the complex temporal relationships in financial data. Where today's patterns might be subtly influenced by what happened much earlier in the trading day.
So it's like giving the model a memory that knows what's important to keep.
Exactly. And the model architecture itself is quite sophisticated, but follows a logical, layered flow building up to the final prediction. It uses 2 stacked LSTM layers. These are the core processing units for analyzing the sequential torque data. These are interspersed with dropout layers. Dropout is a crucial regularization technique to prevent overfitting.
Overfitting, that's when it learns the training data too well, right? But can't predict new stuff.
Precisely. It almost memorizes it, but then fails to generalize to new unseen data. These dropout layers essentially randomly turn off a percentage of neurons during each training step, forcing the network to learn more robust features. Finally, there's a dense output layer, which is a standard neural network layer that processes the aggregated information from the LSTMs and produces the model's prediction. In this case, it's the probability of a stock price increase within the specified horizon. Crucially, the input to this model is specifically engineered to represent the financial torque hypothesis signals. It's structured as a matrix, 36 rows by 2 columns. Each row represents a 5-minute interval containing the 2 key torque values, the VWAP and the trade count for that specific 5-minute period. This input matrix spans a 3-hour look-back window. So the model is analyzing 36 consecutive 5-minute snapshots of this financial torque data from the recent past to make its prediction about the immediate future. This granular yet comprehensive input is designed to capture those subtle, evolving imbalances that drive price movements.
Okay, so a 3-hour look-back window, and then quite specifically, a 3-hour prediction horizon. It's a very precise time frame. Why that particular duration? Why is it so important for this hypothesis? Why not aim to predict, I don't know, the next minute or perhaps the next day or even further out? What's special about that 3-hour window?
Yeah, that's another key question, and it really gets into the practical application and optimal scope of this hypothesis. The 3-hour window for both the historical look back and the future prediction is chosen to strike a delicate balance. It's about capturing sufficient detail while ensuring practical predictability. Consider shorter intervals like 1-minute data or even tick data. While they contain a wealth of information, they're often dominated by market microstructure noise, basically random high-frequency fluctuations. This makes reliable modeling incredibly difficult and often leads to many zero-return periods where price barely moves or only moves due to tiny supply-demand imbalances. They're just too chaotic for consistent, exploitable patterns.
Too much noise, not enough signal.
Exactly. Conversely, longer intervals, like 15-minute or hourly data, would smooth out too much of the critical nuance. They'd miss important short-lived movements and the subtle market microstructure effects that unfold within a few minutes, which are precisely what the financial torque hypothesis is designed to detect. So 5-minute granularity for the input data proves to be an optimal balance. It effectively smooths out some of the high-frequency noise while retaining the rapid intraday trends that constitute torque. Now, the choice of a 3-hour prediction window, again, that's 36 5-minute intervals, is deeply grounded in the natural structure and typical rhythm of intraday markets, as well as practical trading horizons. Intraday price movements often exhibit these multi-hour phases. For example, you frequently observe a strong morning momentum burst shortly after the open, maybe followed by a mid-afternoon reversal, or perhaps a pre-close surge as institutions rebalance. These multi-hour trends are far more reliably captured and predicted than fleeting minute-by-minute oscillations, which often revert to the mean quickly due to market maker activity. By forecasting a few hours ahead, the model focuses on these more persistent intra-session trends. It significantly improves the signal-to-noise ratio of predictions and makes them more robust. A much shorter horizon, like trying to predict the next 10 or 15 minutes, would largely be driven by random micromovements and noise, offering very limited useful signal for a trader. On the other hand, a much longer horizon, say beyond the trading day, would introduce complexities like overnight gaps, macro news events, earnings announcements, things that drastically change market dynamics and make predictions less relevant for a day trading strategy.
Right, keeps the focus on those intraday dynamics.
Precisely. Furthermore, and this is truly crucial for the hypothesis to hold, this 3-hour window captures the period before microstructure frictions and publicly available order flow information are fully arbitraged away. Under the semi-strong EMH, newer information like the trade count imbalances or VWAP deviations we discussed should be incorporated into prices instantaneously. But in practice, as we've discussed, factors like staggered order execution, inventory constraints for market makers, and the sheer heterogeneity of trading strategies introduce a measurable, albeit slight, delay. These aren't perfect markets. These frictions enable our model to detect and exploit these fleeting inefficiencies. By the time high-speed algorithms and competitive liquidity providers have removed the price distortions, the optimal trading window has closed. This 3-hour span, therefore, represents the sweet spot, the perfect means to capitalize on the financial torque hypothesis. It transforms those subtle torque signals into potentially profitable opportunities before the market corrects itself.
And another key methodological choice was framing this as a binary classification problem, basically. Is the stock price going to go up or not? Many might assume predicting the exact future price or the magnitude of the move would be more complete, more valuable. Why did the researchers simplify it to just a binary choice? Up or not up?
That's a very smart simplification, actually, and it's rooted in the inherently chaotic and non-linear nature of financial time series. These are extraordinarily sensitive systems. Even minuscule measurement errors in the input data or unforeseen random shocks can amplify rapidly over time. This renders direct, precise price-level predictions inherently unstable and highly unreliable. Attempting to predict exact price values typically leads to exponential error magnification, making the model practically useless in real-world dynamic conditions. It's like trying to predict the exact path of a single raindrop in a hurricane, almost impossible.
So predicting direction is just more robust.
Exactly. By predicting only the direction of movement up or not up, meaning down or flat, the model sidesteps this profound instability. It allows the model to harness the more persistent and discernible structure of intraday trends, rather than getting lost in the noise of exact price fluctuations. From a practical standpoint, it's also far more actionable for traders. They primarily need to know whether to buy or sell or stay out, not necessarily the precise future price point down to the cent. It simplifies their decision-making process significantly. Moreover, this approach aligns better with extensive empirical evidence in machine learning research. It consistently shows that binary classifiers tend to generalize better and yield higher reliability and robustness in volatile, noisy markets compared to attempting multi-category classifications or precise regression predictions. It's about finding the most useful signal, not necessarily the most detailed, in a highly unpredictable environment.
They tested this hypothesis on some really big names too, and major market indicators, not just, obscure stocks. What kind of data did they use? How robust was their data set in terms of breadth and historical depth?
Yeah, they were very careful about that. They meticulously selected a diverse and highly liquid set of companies and market indexes to ensure their findings weren't limited to just a niche corner of the market or a particular industry. This included individual tech giants that represent a significant portion of the market's pulse. NVIDIA, NVDA, Apple, AAPL, Microsoft, MSFT, Amazon, AMZN, and Alphabet, GROG. These companies are not only among the largest by market cap, but also incredibly highly traded, providing really rich data streams. And to capture broader market trends, they also included major market indexes, or rather their corresponding ETFs.
Yeah.
The S&P 500 ETF, VOO, the Dow Jones Industrial Average ETF, DIA, and the Russell 2000 ETF, IWM. This provides a really well-rounded perspective on both individual stock performance and overall market sentiment and direction.
So a good mix of big stocks and the overall market and the data itself. Where did it come from and how far back did it go?
All of this extensive data was collected via the Alpaca Trading API, directly sourced from the Securities Information Processors, or SIPs. For those unfamiliar, SIPs are essentially the official consolidated feeds for all U.S. market data, providing real-time, high-fidelity information from all exchanges. This ensures the data's integrity and comprehensiveness. The dataset itself spanned a truly substantial period, from January 1st, 2016, all the way through December 30th, 2024.
Wow, that's almost 9 years.
Exactly. Nearly 9 full years of granular historical data encompassing various market cycles, bull runs, bear runs, significant global events, you name it. This massive amount of data adds significant statistical power and robustness to their findings. It allows the model to learn and validate patterns across really diverse market conditions. Back in the day, getting this kind of consolidated clean market data was a Herculean task, often requiring expensive proprietary feeds. The fact that researchers now have access to this quality of data via accessible APIs really accelerates discovery. It pushes the boundaries of what's possible in financial modeling.
Right. And they did something important with the prices too, didn't they? Adjusting for splits and dividends.
Oh, absolutely critical. A critical and often overlooked pre-processing step they undertook was back adjusting all historical prices for corporate actions, like stock splits and cash dividends. This is absolutely essential for creating a meaningful, continuous time series. For instance, if you plot raw data, a stock split will instantly halve or multiply share prices, creating sharp artificial gaps that misstate the true total return or genuine price movement. Similarly, a cash dividend causes a stock's price to drop by the dividend amount on the ex-dividend date. Without adjustment, these appear as sudden, misleading price drops. By rigorously back-adjusting, they ensure a smooth, continuous price series that accurately reflects the true economic impact and underlying value changes, avoiding misleading jumps from purely mechanical events. It ensures their indicators measure genuine growth and yield. Finally, this meticulously prepared data was then rigorously split. 60% for training the model, 20% for validating its performance and tuning parameters, and the remaining 20% for final testing. That's a standard and highly robust approach. This ensures the model learns effectively, is optimized without overfitting to the training data, and is ultimately evaluated accurately on completely unseen data. It prevents any form of data leakage or bias that could inflate reported performance.
Now, this is where the results of their rigorous testing really become eye-opening, some truly surprising discoveries related to the data itself. The study highlights two particularly counterintuitive findings: the unexpected value of full session data and the frankly perplexing impact of feature scaling. Okay, let's start with the full session data. Most people, when they think of market hours, only consider the standard 9:30 a.m. to 4:00 p.m. Eastern Time. What's the big deal with including more? How significant was this finding?
Yeah, this finding is indeed a central and quite counterintuitive revelation for many, even experienced traders and data scientists. The researchers meticulously used two complementary data sets to compare performance, explicitly trying to isolate the impact of different trading hours. First, they used regular session data. This data set included only the standard market hours, 9:30 a.m. to 4:00 p.m. ET. This is what the vast majority of retail investors and many models typically consider trading hours. Second, they developed full session data. This data set went far beyond the regular hours, painting a much more complete picture of the trading day. It included pre-market activity, specifically from 4:00 a.m. to 9:30 a.m. ET, and post-market activity, from 4:00 p.m. to 8:00 regular hours. So we're talking about capturing activity across 16 hours of the day rather than just 6.5.
16 hours versus 6.5. Okay.
And the striking and consistent result was that models trained on full session data consistently and significantly outperformed those trained only on regular session data. This wasn't a minor difference. It points to a profound informational edge gained by observing the entire trading cycle.
So that pre-market and after-hour stuff really matters.
It really seems to. If we connect this to the bigger picture, it implies that activity occurring outside standard trading hours, often dismissed as thin, illiquid, or noisy, actually offers critical additional predictive insight. Think about the dynamics. Major overseas markets might react to global news overnight, creating a ripple effect that impacts pre-market sentiment in the U.S., or a key earnings whisper might circulate after hours, influencing early institutional order flow as large players adjust their positions. Perhaps a significant block trade occurs quietly in the post-market, signaling a shift in institutional conviction. These initial and late impulses often set the tone for the next day or respond to critical information not yet fully absorbed during regular hours when volume is highest. By including this comprehensive data, the model gets a much richer, more nuanced picture of how information truly propagates and translates into torque throughout the entire trading cycle. It reveals subtle but powerful predictive signals that are otherwise completely missed when focusing only on the core hours. It's like getting a much fuller narrative of the day's market story, not just the middle chapters where everyone is paying attention.
Okay, can you give us some concrete numbers to illustrate this? How much better did the full session data actually perform? We're talking about real, measurable differences in predictive power here, right? Not just theoretical advantages.
Absolutely. The improvements were not only consistent, but truly substantial, providing strong empirical support for their hypothesis. While not all assets benefited equally, the overall trend was overwhelmingly positive across the board, demonstrating the tangible value of this expanded dataset. For example, the model predicting the direction of the Dow Jones Industrial Average ETF, DIA, saw a significant 15.23% increase in accuracy when trained on full session data compared to regular session data.
15%. That's huge for predicting the Dow.
It's a massive leap in predictive power for a major market index, indicating that the early morning and late evening trading activity in large-cap stocks holds significant foresight. Similarly, individual high-growth stocks also benefited. NVIDIA, NVDA, a notoriously volatile and news-driven tech stock, experienced a substantial uplift, with a 14.08% increase in accuracy when its model incorporated full session data. This demonstrates the value of this extended data even for highly active individual equities. Perhaps most notably, the S&P 500 ETF VOO model showed an impressive improvement of 12.32% when moving to full session data. And this resulted in a remarkable test accuracy of 87.41%. Let's put that into perspective. This means that over 21 months of previously unseen test data, a truly significant and robust period covering diverse market conditions, the model accurately predicted whether the stock price of VOO would rise in the next 3 hours, 87.41% of the time.
87% accuracy on the S&P 500 for the next 3 hours.
Exactly. This was, in fact, the highest performance across all tickers tested. It illustrates how the financial torque hypothesis, through these granular VWAP and trade count features, can unlock particularly strong and reliable directional signals, especially in highly liquid, broad market instruments like a major index ETF. This compelling result strongly supports the idea that off-hours trading data, often overlooked, is not just noise, but is crucial for significantly improving the accuracy and robustness of short-term price predictions. It really feels like a game changer for understanding the market's true rhythm.
That's truly a profound impact, a 15% improvement simply by including more hours of data. Makes you wonder what other hidden signals exist. But then there's the other surprising finding, and this one really challenges conventional wisdom in machine learning: feature scaling. This is a standard Almost ritualistic practice in machine learning, right? Where you normalize your data to help models learn better and prevent some features from dominating others. Yet the paper suggests something completely counterintuitive here. What did they discover about feature scaling?
Yes, this indeed raises a critically important question for machine learning practitioners and directly challenges a long-held fundamental assumption in the field. Feature scaling, which involves various techniques like standard, min-max, or robust scaling, is almost universally performed to normalize data. The conventional wisdom dictates that this helps models converge faster during training, train more stably, and often perform better by putting all features on a similar scale. It prevents features with larger numerical ranges from disproportionately influencing the learning process. However, in this specific study, the researchers found the exact opposite to be true. Omitting scaling consistently yielded superior performance. The no-scaler configuration, meaning training the LSTM networks directly on the raw, unmodified VWAP and trade count data, achieved the highest predictive accuracy across all assets and in both the regular session and full session datasets.
Wait, so not scaling the data worked better? That seems backwards.
It does seem backwards based on standard practice. It really throws a wrench in what many of us have been taught in machine learning for years.
So what does this all mean? Why would not scaling the data work better in this particular financial context? It seems to fly directly in the face of common machine learning wisdom that's almost ingrained in every practitioner. What unique property of this financial data, or maybe the financial torque hypothesis itself, makes raw data superior?
This is a profound insight, I think, into the nature of financial data and how sophisticated models like LSTMs can perceive it. It suggests that for financial time series, and specifically for the financial torque hypothesis, which relies on the intrinsic interplay of price and volume magnitudes, the raw intrinsic magnitude information and the original distributional structure of the market data provide incredibly important signals for the LSTM models.
So the actual numbers, the raw values, contain information that scaling removes.
It appears so. The absolute price levels, the actual volume numbers, how many share and traded, and their raw distribution patterns across price ranges, these contain crucial unnormalized information about market sentiment, underlying volatility patterns, and subtle liquidity dynamics that the network is able to exploit directly. For instance, the absolute size of a trade count or the specific range of VWAP might inherently signal something about institutional activity or market conviction that gets obscured when scaled. Normalization, it seems, can inadvertently compress or even eliminate these meaningful variations. By scaling data to a fixed range, like 0 to 1, or to a standard normal distribution, you might be removing subtle but crucial information about how truly large or how truly small a particular trade count or VWAP deviation is in its raw, unadulterated form. The raw data retains these vital cues about absolute price levels, the force of volume, and inherent volatility patterns that the network, with its powerful pattern recognition capabilities, is able to exploit directly. The implications here are significant for anyone developing financial forecasting models. The role of input scaling needs to be carefully reevaluated. It might be counterproductive to apply it universally without rigorous empirical testing for each specific dataset and model. It tells us that sometimes the raw, unfiltered truth of the market is exactly what these sophisticated models need to see, rather than our attempts to clean or standardize it. It's a powerful reminder that conventional wisdom isn't always the ultimate truth when dealing with complex, real-world data.
So we've introduced a novel hypothesis, demonstrated its implementation with a powerful machine learning model, and uncovered some truly surprising findings about data processing. If we connect this to the bigger picture now, what do these results really tell us about the fundamental nature of financial markets and long-held theories like the efficient market hypothesis? Does this mean the EMH is definitively wrong, or is it more nuanced than that?
Well, this study directly and powerfully challenges traditional idealized views of market efficiency, particularly the semi-strong form of the efficient market hypothesis. The EMH, as famously formalized by Eugene Fama decades ago, posits that asset prices fully reflect all available information instantly. This renders it impossible for any market participant to consistently profit from future price movements through arbitrage. In its strong form, it even extends to private information. The core idea is that if prices instantly incorporate all information, there are no exploitable patterns or free lunches to be found. Price changes are purely random, driven by unpredictable new information.
But these results seem to show patterns that are exploitable, at least for a few hours.
Exactly. The finding that the financial torque hypothesis, leveraging these highly specific microstructure features like VWAP and trade count distributions, carries such significant and quantifiable predictive value. It suggests that price movements may not always be perfectly efficient. at least not in the ultra-short term. The ability of the model to exploit these microstructure-driven trade imbalances, especially those revealed by including extended trading hours data, points to persistent anomalies or fleeting inefficiencies that are simply not immediately arbitraged away by other market participants. Now, this doesn't necessarily mean the EMH is entirely wrong or invalid at all levels, but rather its assumptions about instantaneous and perfect information incorporation might not hold perfectly in the incredibly nuanced real-time dynamics of market microstructure. There are windows of opportunity, perhaps fleeting, but consistently detectable by a sophisticated lens like financial torque. It's a subtle but profound distinction, highlighting that efficiency can be a spectrum, not an absolute.
This observation seems to align much more with the field of behavioral finance, doesn't it? The idea that markets aren't always purely rational or perfectly efficient, and that human or institutional factors, or even just the mechanics of trading, play a significant role in creating these inefficiencies.
Exactly right. This observation aligns much more closely with behavioral finance theories. These theories suggest that markets are not always perfectly efficient due to a range of factors that introduce subtle frictions or delays in information processing. This can be due to several things. First, institutional trading dynamics. Large institutional orders, like a pension fund needing to buy or sell a massive block of shares, cannot always be executed instantaneously without moving the market. They often have to spread their orders over time, introducing a staggered flow that creates imbalances the torque model might detect. Second, liquidity imbalances. Supply and demand are not always perfectly matched at all price levels, creating temporary vacuums or surges that can be exploited. If there's a sudden influx of buying interest at a certain price and not enough sellers, the price will naturally be pressured upwards until new supply arrives. And third, investor sentiment and human behavior. While this study focuses on technical indicators, these indicators are ultimately a reflection of collective human and algorithmic behavior. Even if not directly analyzing news sentiment, the aggregated action of traders reacting to news, rumors, or even herd mentality can introduce delays in information incorporation. These frictions prevent the instantaneous and complete absorption of all information.
So the market isn't a perfect machine. It has these real-world constraints.
Precisely. The study very clearly highlights that trading activity and liquidity conditions, particularly those observed during the extended pre- and post-market trading hours, play a surprisingly crucial role in shaping these short-term price movements. These are precisely the latent market forces, the subtle pushes and pulls of supply and demand, the unseen battle between buyers and sellers that the financial torque hypothesis aims to capture. The fact that these patterns endure long enough to produce observable intraday momentum suggests that certain frictions, like order execution delays, market makers adjusting their inventory risk, or algorithms reacting in slightly delayed sequences, genuinely exist. These delays prevent instantaneous arbitrage by all market participants and thus allow for these fleeting inefficiencies to be detected and exploited by a sophisticated model like the one developed in this research. It's a testament to the incredibly complex interplay of human decision-making, automated trading algorithms, and market mechanics that creates these subtle yet exploitable patterns. It pushes us beyond the textbook definitions of efficiency into the messy, real-world reality of trading.
This has been a truly eye-opening deep dive. The financial torque hypothesis offers a novel and compelling framework for understanding market movements, and the results are, frankly, impressive. But no study is perfect, right? Especially in a dynamic field like finance. What are the limitations of this initial research, and where do the authors suggest future work should go to further refine this concept and move it closer to practical, real-world application?
That's a great point, and the authors themselves are remarkably transparent about the journey ahead. They acknowledge that while the hypothesis shows remarkable promise and impressive predictive power in their backtesting, further rigorous exploration is indeed needed. They need to fully understand its dynamics and, critically, its real-world applicability in live trading environments. They outline a few critical avenues for future work, really pushing the boundaries of this research. First, they strongly suggest exploring specific market conditions and further feature engineering. This isn't just about adding more data, it's about investigating when and under what precise circumstances the trade count distribution within the VWAP range exhibits its strongest predictive power and how that power might fluctuate. For instance, does this torque behave differently during periods of extremely high market stress, like a flash crash or a sudden unexpected geopolitical event? Or what about during the intense, news-driven periods of earnings seasons, when companies release their quarterly results or immediately following key macroeconomic announcements like inflation data or interest rate decisions? The relationship might be significantly more pronounced, or even change in direction during highly volatile periods versus calm, range-bound markets. This would inform traders when the model's signals are most reliable.
So, figuring out when the torque is strongest makes sense.
Yeah.
What about adding more data types?
Yes, they also propose feature expansion. While they deliberately kept the input features minimal, just VWAP and trade count for this foundational study, to prove the core hypothesis without confounding variables, incorporating more granular order book data could provide an even more detailed picture of market forces. Imagine adding data points like the bid-ask spread, which shows the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. A tighter spread often indicates higher liquidity. Or integrating order flow imbalance, which quantifies the net flow of buying versus selling pressure from actual orders placed and executed. These deeper layers of market mechanics showing real-time supply and demand could potentially reveal even more subtle forms of financial torque, refining the model's sensitivity to minute shifts in market sentiment and liquidity. It's about peeling back another layer of the market's onion, so to speak.
Okay, so refining the inputs. What about testing it in the real world? That seems like the ultimate test.
Absolutely. And perhaps most critically for practical application, a major area for future work is the real-world applicability of the financial torque hypothesis through more rigorous model evaluation and backtesting in real-world scenarios. This initial study utilized extensive historical data, which is robust for initial testing and validating the core hypothesis. However, to truly assess the hypothesis's robustness and its ability to handle the messy, unpredictable conditions of live markets, further validation is absolutely needed in simulated or even actual live trading environments. This is crucial because it means accounting for practical considerations that historical data often doesn't capture easily or that are highly dynamic.
Like trading costs, slippage. Things like that.
Exactly. For instance, transaction costs, the fees you pay to your broker to buy and sell shares, can significantly eat into profits, especially for high-frequency strategies where many trades are executed. A strategy that looks profitable on historical data might become unprofitable once commissions are factored in. Then there's slippage, which is where your execution price differs from your expected price, particularly in fast-moving markets or for large orders. If you expect to buy at $10 but actually fill at $10.05 because the price moved in the milliseconds it took for your order to execute, that can drastically impact profitability. Other market frictions, like latency delays in receiving market data or sending your trade orders to the exchange, also need to be considered. Even microseconds can matter in this high-speed environment. Moving beyond purely historical backtesting to paper trading, simulated live trading with virtual money in real time, or even actual live trading would provide invaluable insights into how well these models and the financial torque hypothesis generalize under actual dynamic and competitive market conditions. This demanding process would truly evaluate their effectiveness in making actionable, consistently profitable trading decisions in real time under real pressures. It's the ultimate proving ground for any financial forecasting model.
So what does this all mean for you, our listener, who wants to be well-informed and perhaps even apply some of these insights or just better understand the financial world? What's the takeaway?
Well, I think it fundamentally underscores that even in complex and seemingly random financial markets, there are powerful underlying structural dynamics and transient inefficiencies. And advanced analytical tools like LSTMs, when paired with novel hypotheses like the financial torque, can indeed uncover them. It's a powerful reminder that markets, despite their reputation for being perfectly efficient, are not always perfectly smooth, frictionless, or entirely random. There are subtle patterns if you know how to look for them. This research encourages a deeper, more critical thinking about how information is truly processed and reflected in prices in real time. It prompts us to question even well-established theories like the efficient market hypothesis. We shouldn't blindly accept that all information is instantly priced in. Rather, we should recognize that there are intricate microstructural nuances and time lags that sophisticated models can detect and potentially leverage. For a professional trader and discerning investors, it offers actionable insights into designing more adaptive, data-driven trading strategies. It highlights the profound importance of market microstructure indicators like VWAP and trade count. It also emphasizes the significant, often overlooked value of utilizing comprehensive trading session data, including those crucial pre- and post-market hours, to gain a more complete picture of market forces. It's about leveraging every bit of information available to understand the market's hidden gears and subtle influences. #outro.
What an incredible deep dive. We've peeled back the layers on the financial torque hypothesis, A truly innovative concept that reimagines market momentum not as some abstract force, but as a measurable, potentially exploitable phenomenon. We've seen how cutting-edge machine learning, specifically LSTM networks, can unlock surprising predictive power by intelligently focusing on just two core features: volume-weighted average price and trade count. And we've learned the truly counterintuitive lesson that sometimes, in the nuanced world of financial data, less pre-processing, like intentionally omitting data scaling, can actually be more effective, revealing the raw signals the market is trying to tell us.
And we've seen how absolutely crucial it is to consider the full trading day, including that pre- and post-market activity, to capture the nuanced dynamics that contribute to accurate short-term predictions. Those extended hours yielded truly significant improvements, like that impressive 87.41% accuracy on the S&P 500 ETF, VOO. It demonstrates the tangible, measurable benefits of adopting a comprehensive data approach. It truly reshapes our understanding of where market insights really lie.
This deep dive unequivocally challenges the very notion of perfect market efficiency. It suggests that opportunities for understanding and even predicting short-term movements might exist where traditional theories say they shouldn't. It's a powerful reminder that even in highly optimized and seemingly random systems, there can be subtle, persistent, and potentially exploitable patterns if one looks closely enough and with the right analytical tools.
It prompts us to consider that beyond the often chaotic surface of financial markets, there are persistent, subtle patterns. They're driven by the continuous interplay of liquidity, order flow, and fragmented information, much like a hidden torque. These forces quietly but consistently shape price movements, just waiting for the right analytical framework and advanced models to be revealed.
And that leaves us with a provocative thought for you, our listener, to mull over. If even the most efficient financial markets still hold fleeting inefficiencies detectable by financial torque, what other hidden forces might be shaping the world around us? Other seemingly random systems just waiting for the right lens, the right hypothesis, and the right tools to be revealed and understood. Thank you for joining us on this deep dive. Until next time, keep exploring, keep questioning, and keep learning.